So I want to talk to you about hedging today because I've had a lot of people ask for videos on hedging. This topic can be a little complicated, but today I just wanted to give you some basic thoughts of mine as far as some of the things that I do in my trading to hedge for not just market crashes, but also hedge for volatility spikes as well. So when you're trying to hedge an options portfolio, typically you're trying to hedge for market crashes. And typically how you're going to do that, you do that really in two main ways. You typically do that with long puts or long put spreads or a combination of those two particular trades. So you typically are going to use a product like ES or MES, so the S&P 500 futures. What you're going to do is you're just going to have some long puts. Like that's a long put, that's a long put, that's a long put. There's four different way out of the money long puts there. Those things are essentially crash protection. If the market drops, in this case, the market would have to drop about 1,200 points for these puts that are so far out of the money to actually do anything. But the point is, those are for serious events. And then you've got put debit spreads, which are for less serious events. Obviously, you don't make nearly as much money on a put debit spread as simply a naked long put by itself. But the put debit spreads are nice because they're very cheap, small little trades. Of course, the cheap trades, you don't spend as much money on. You also don't get as much reward should you get that big market crash. As a matter of fact, I really don't consider put debit spreads as really crash protection. They're more grind down protection. So it's the market stair stepping down. For example, 2022 was a perfect example. 2022, the market didn't crash, but the market went down all year. The market ended up being down 20% in 2022, but it wasn't a 20% drop in a day or a week. It really took the whole year to drop 20%. And had you been purchasing a lot of these put debit spreads and products like ES or MES, or if you wanted to use index options, SPX, if you had a lot of put debit spreads on that year, you made a lot of money. So those really are the two main things you probably want to start adding to your options trading, is occasionally buy some really far out of the money puts as crash protection. And then on put debit spreads, don't go crazy out of the money with these. Go 20 deltas, 30 deltas, somewhere in that general range. Don't go to like a 5 delta put debit spread because you're really planning for a crash at that point. And if you're going to do that, you're going to go buy a 5 delta put debit spread, buy just the 5 delta put, right? That's what you should be doing, because if you're planning for a market drop of that magnitude, debit spreads are not going to profit enough. They're not going to save you where those long puts by themselves will. Now, some people often wonder, hey, you're spending all this money on these long puts and these put debit spreads in ES or MES or SPX, or if you want to use the ETF, maybe you're doing this in SPY, whatever it is. I'm using the futures products here, but these long puts and these long put spreads, they cost money, right? They're debit trades. You have to pay for them. And you're not ever going to win on these things. Maybe once every few years, the market will crash and some of these things will pay off. So aren't you just losing money putting these things on? And of course, the answer is yes. These are hedges. These are insurance policies. So what you want to do, you don't want to put these things on unless you really think you need to put these things on. So you have to be somebody that's taking some chances. Are you taking a lot of risk in your trading? If you're somebody that puts on, for example, a lot of naked short puts in ES and MES or SPY, things like that, then you need to be hedging a little bit, right? You're trying to make a whole lot of money. You're trying to be a risk taker. Then occasionally buy those way out of the money long puts in ES, for example, again, just as a little bit of a hedge. Yeah, you're giving up some of your profit potential, but when that bad event happens, it's probably worth it. And it's not like the hedges are going to necessarily make you money. They're there really to limit your losses. Again, the hedge is not a primary strategy. A lot of people think hedging is about making money. Well, no. If the hedge becomes your primary way to make money, it's no longer a hedge. That's actually your primary strategy, right? So you can't have a primary strategy and then have a hedge that's also another way to make money. No, that's not the way it works. Think of hedging as really an insurance policy so that when a bad event happens, you're still going to lose money. You're just going to lose, hopefully, a lot less. So naturally, the question comes up, how much should I be spending on hedging? Well, I think a lot of that has to do with, again, how much risk you take in your trading. If you're someone like me right now, I don't have a lot of really risky positions on. I'm not really that far out there, trying to make a ton of money by putting myself at risk. I don't spend that much on things like these put debit spreads and these long puts. But if you're somebody that, again, takes a little bit more risk, you need to be a little bit more aggressive with your hedging. The way I would suggest doing this is I would suggest at a minimum spend 1% of your net lick account value each year hedging. For example, let's say you have a $100,000 account value. So over the next year, you're going to spend at least 1% of your net lick account value, which in this case would be $1,000 on hedges. So however you want to divide that up, whether it's every month, every quarter, just have a set time frame where, I'm going to take $1,000 and let's say we break it into quarters. Every quarter I'm going to spend $250 on long puts and MES, put debit spreads and MES, a combination of the two. However you want to divide that up, you just have that in your mind. Now, I say that is for somebody that's not a risky kind of trader. Now, if you're somebody that's taking a little bit more risk in your trading, you guys probably need to spend more than 1% of your net lick account value. You probably want to bump that up maybe to 2%. So spend $2,000 a year if you had a $100,000 account, right? And again, divide that up every month or every quarter and just you have that set dollar amount in mind every month, every quarter, and you go buy those puts, buy those put debit spreads. And there's some interesting things you can do other than just going and buying a put or a put debit spread, right off the bat. Sometimes you can turn existing trades into these hedges. One of the things I like to do, I like doing ratio spreads. In particular, I like doing these back ratio spreads where I sell a short put. In this case, what I did is I sold the 16 delta short put, and then I went and bought two delta long puts. Now, why did I choose these 2 delta long puts? It's because these puts were priced exactly perfectly where as long as I profit 50% on the short put, so once this thing reaches 50% max profit, I take it off for 50% winner. 50% winner of that short put pays for the 2 long puts. So, if I put this trade on around 90 days. If at some point before expiration, I win at least 50% on the short put, which most of the time you're going to win rather quickly on that thing. You're probably going to be in and out of the short put within, say, 3 weeks, 4 weeks, and then you've got a ton of time that you can leave those free long puts. Essentially, they're not free because you had to win on the short put, and there is some risk you're taking by having the short put on. But assuming you win on the short put and then leave the long puts on, you essentially get kind of a free hedge at that point. One other neat thing I love to do is sometimes I will turn my put debit spreads into simply a long put. So let's say that every week or every 2 weeks, some regular time frame, I buy a put debit spread. And let's say I buy these put debit spreads typically at 90 DTE. Well, typically these things, they essentially become max losers pretty quickly, especially in a bull market like we've had the last 2 years. I'm not making any money on these put debit spreads because these are really grind down protection, a bear market, right? We're not in a bear market. So most of the time you're losing on these put debit spreads. And once they become nearly max losers, right? So once they get especially 95% or more of a loss on especially the short put, just go ahead and close the short put, right? You've made about as much money as you could possibly make on the short put of this trade, so let's just close it. I got filled in that, and now what I've essentially done is what was a put debit spread has now simply become a long put, a way out of the money long put, right? So I already took all the profit on the short side of that debit spread. I left the long side on, which I'm down money on. I'm probably going to still lose this money, but if in the next 25 days the market crashed hard, so if the market came down at least 700 points or more, which would be a serious event, it's going to be really nice that I took off that short put and had this long put still on, because I make much more money in this case. Remember, the put debit spreads, they make a little bit of money and they're good in a grind down market, but in the event of a crash, you want just the long put on. You're going to make far more. So a lot of times I'll put these put debit spreads on at like, 70, 80, 90 DTE. And then as time passes and these things become nearly a max loser, I'll take the short put off, leave the long put on, and kind of get, it's not a free hedge because you paid for the debit spread up front in the first place. Plus, it's never going to be where the short put pays for the long put. There's always a little bit of a price discrepancy. So when you take the short put off, you're still costing yourself a little more money to keep that long put on, but it's just a little bit amount of money. But that's one thing you can do where you start the trade for grind down protection as a put debit spread, and then as the trade progresses, you take off the short put for the crash protection and just keep the long put going. And you can do that with other types of spreads. It doesn't necessarily just have to be a put debit spread. Sometimes I will do this with long put condors. For example, this is a long put condor that I put on 32 days ago. For those unfamiliar with what a long put condor is, it is essentially a combination of a put credit spread and a put debit spread, and very similar to the put debit spread. This is for making money in a grind down market. If the market slowly gets into this condor, into the range of that condor, I make a little money, right? I'm not going to make a ton of money, but it's a nice little chunk of change, especially since I didn't pay very much for this condor. These are typically very cheap little trades. But this is another trade that if I want to, as this thing becomes a full loser, it's nowhere near a full loser yet, not enough time has passed, but as time passes, all these options are going to start losing a ton of value. Eventually, the short options will reach like a 95% or more winner, max profit, and then I'll just take those off, and then I'll just leave the long puts, 4 long puts in this case of this particular condor, I would just leave them on again as that crash protection hedge. Now let's talk about volatility spikes very quickly. So for a vol spike, long puts in the ES or the MES, long puts will profit from volatility increasing. So they are also a little bit of a volatility hedge. They're a delta hedge, a directional hedge, but they're also a volatility hedge as well. But if you feel like you really need to hedge for volatility, like that volatility spike that we had back on August 5th, buy some VIX calls. So what you want to do here is kind of like what you do with long puts in ES, where you go buy really far out of the money long puts in ES. Well, go buy some really far out of the money long calls in VIX, and that is your volatility hedge. And there's really nothing else to say there. If you feel like you need to spend that money on those VIX calls, go buy some VIX calls. How much money should you be spending on that? Well, again, I would actually factor this in with your hedging costs. If you feel like you need to spend 1% a year on hedging or 2% a year on hedging, then just factor in that part of that 2% you're spending every year is going to be some VIX calls in conjunction with those long puts and long put spreads in ES. So there you have it, just some of my thoughts on hedging, some of what I do in my trading. I regularly, especially on MES, buy a lot of put debit spreads and then eventually turn them into long puts. Sometimes I just buy the long puts outright, especially if the market is very volatile or I'm feeling a little worried about the positions I have on. I feel like I need some extra protection. Just go buy some puts. That's really all there is to it. Now, before I go, I do want to mention to you guys, if you haven't checked out my book, please check out my book, The Super Wheel Option Strategy, available over on Amazon. This is about my favorite option strategy, which is the wheel strategy. You'll find a link to my book in the description below. Also, if you want to help support this channel, subscribe to the DT Options Discord. I hold a live voice chat there each and every trading day where I share my trading platform that you guys got to see here on screen. Share my trading platform, and you guys get to see all my opening trades and closing trades, and you get to bounce ideas off of me. I get to bounce ideas off of you, and we have a nice trading community over there, and we would love to have you. Peace, guys.